Welcome to another episode of The Brand Called You, a podcast and podcast show that brings you leadership lessons, knowledge, experience, and wisdom from thousands of successful individuals from around the world. I'm your host, Ashutosh Garg, and today I'm privileged and delighted to welcome not just a very, very dear friend, a fellow co-host of The Brand Called You, a member of the YPO, but also a fintech guru who I trust with everything that I have, and a recently published author from Florida, USA, talking to us today from Gurgaon, India, Mr. Sandeep Tyagi. Sandeep, welcome to the show.
Thank you so much, Ashutosh. And those are so many good things that you said. And also, you've been the main inspiration for writing the book. So this is great to come here and talk about the book and the journey to get to that with you.
Thank you. Sandeep, as we've seen in our earlier episodes, and of course you've seen him as a co-host, is the chairman and chief executive officer of Estee Capital and the founder of Gullak. Today, we are not going to talk about all his amazing achievements in the world of finance, but we're going to talk about his book, which covers his journey in the world of finance. His book is titled The Little Book of Big Gains. It is available on Amazon for pre-order. And as I mentioned, Sandeep is a member of the YPO. So Sandeep, my first question to you, can you share your personal journey in the investment sector? And what are some of the challenges you faced in the 2008 financial crisis?
So, Ash, everybody learns, as they say, from your biggest mistakes and stumbles. So 2008 was a watershed year for me in understanding what does it mean to have good investment plan. I had just sold my last venture, Inductis. So I was sitting with a lot of liquidity. And I had the advice and help from some of the largest financial advice companies in the world. But still, during the 2008 financial crisis, I lost over 50% of my net worth. Now, that was obviously painful financially. But even more, it was painful emotionally. It's very difficult to handle those numbers going down and feeling helpless as you go through it. So I realized two things. One, that I need to learn a lot more about this, even though I have degrees from some of good colleges in engineering and management, but I knew little about investment. So I needed to learn. And the second thing was, it's no good if your investment and savings plan is not rock solid, because you can keep earning money, but if you have a leaky bucket, a lot of it just goes away.
Very well said. So let's jump straight into your bucket, into your book, Sandeep. And when I was looking at your title, three sets of words really sprung out at me. Number one, you call it the little book. I think for people who are going to be putting a lot of their money, there's a lot of wisdom in it. Second, you talk of big gains. And the third one, you talk of investing wisely. All three very, very critical phrases, which you seem to have captured in your book. My first question is, what was the inspiration to write the Little Book of Big Gains? And how is this book different from so many other self-help books on finance and investment?
So the reason I called it the little book, I had a big discussion with my publisher who obviously wanted to make it more substantial, because if somebody's going to pay money, they want to hold a more substantial book in their hands. But the reality is, investment for most people should be a simple activity. It's not that complicated. It's simple, but it is difficult to implement for different reasons, not because it's difficult to understand. Now, the little signifies the amount of knowledge you need to connect to become better than an average investor. So a little knowledge makes you better than the average investor, and that's what most people need to do their investment planning. So I didn't want to overcomplicate it. Actually, less than half the book is what contains what you need to know to invest wisely. The rest of the book is what not to know and pay attention to, because we are surrounded with so much noise and so much distraction and so much desire to continuously act, which is not to our benefit, that I've tried to explain that as well. So actually, it's a little book, and even half of it is sufficient to make you better than average.
Well, I've had the privilege of reading the draft of your book, and I think it is of incredible amount of value for every viewer and listener who's listening to our conversation. But my next question, Sandeep, is how do you define a good investment plan? And what are some of its essential components? And a linked question is, what is a realistic expectation?
Look, what make any plan a good plan, and that's certainly true for a good investment plan, is number one, it should be understandable. It should meet the objectives for which it is being created. And it should be implementable with less or possible effort that you can put into it. So that's what makes a good plan. Now, realistic expectation part of it is actually very important, because many a times, and that's true for a lot of people when they go looking at their spouses, they have expectations that they create in their mind of what that relationship would look like. But if they look around their peers and they are a little bit smarter about creating a proper realistic expectation of what relationships are like, they'll be happier. Same thing with investments. I think on average, if you are making long-term 10, 12, 13% returns, you're doing very well. Equity markets in aggregate, even in reasonably fast-growing markets like India, would produce 15, 16% returns over long periods of time. But most people end up expecting the moon. They want to do 25% return, and we can talk about why that is, but that's the source of a lot of unhappiness and actually mistakes that people correct. Mistakes people do because they have unrealistic expectation from what to get from their investments.
So what you're saying is, don't expect to double my money every year.
Yes, don't expect to double your money, and don't believe that one friend who after 2 whiskeys tells you that he tripled his money.
Well said. You also say, Sandeep, in your book that good investing is like good eating. Can you tell me a little bit more about this analogy?
So, good investing and good eating, the common theme between the two is, if you just step back and use your common sense, it's not that hard to figure it out. We know if you eat a balanced diet with some portion control, you're going to be healthy. And we have seen plenty of evidence in our own life when we do that. It works. We are in healthy weight, we feel good. It works towards our benefit. Same thing with investments. If we do proper diversified portfolios, it works and we make good returns. However, we are constantly chasing that single magical diet or a superfood. If we drink that ajwain water at 6 a.m. in the morning and then follow it up with something in green sprouts, then magically our weight will come down. And it doesn't really work. We try one thing after the other, and same thing with investments. We chase one theme. Now it is invest in Bharat growing or defense stocks or energy transition. And that fad lasts for a little while. We get disappointed and then we move on. But if we just followed common sense investing, simple principles, and implement them systematically and continuously, we'll do well.
Well said. Well said. And my next question, Sandeep, is what are some of the common pitfalls investors fall into? And as I was reading and thinking about what you have said, when I was much younger, I used to find that if I was losing money, I would say, let me double my bet. And I would end up losing even more. I'd love to get your perspective.
So there are, I think, two issues. One is lack of education, kind of just awareness. And it's not complicated, but just basic awareness. What type of investments are there? What to expect from them? Knowing historically what different products have done and what can they do. So there is lack of basic information and education about investment. But even if you have the education, and I had an MBA where I'd done a lot of these courses, the second big hurdle is all the psychological hurdles that we have in sticking to a plan or actually doing a proper investment um, handling the volatility and emotional pressure that a volatile market creates. And in the book, I cover many of these. You said if you lose money, you don't want to sell. And there is well documented effect of loss aversion. People hate losing money.
Correct.
So if you have bought something at 100 and it's now at 90, you don't want to sell till it comes back to 100. On the other hand, the benefit you get by it going up is about half of the pain you feel when it goes down.
Correct.
So these effects create irrational behavior. If today you bought something at 100 and tomorrow it's at 90, if you really were convinced that it's a good investment, you would be happy and say, okay, let me buy a little bit more and make that investment even more worthwhile. But that's not how we feel. So these emotional biases of loss aversion, overconfidence, everybody feels they're a better than average driver. There have been studies, one after the other. When people are asked, are you better than average? Everybody says yes. Obviously cannot be true. Same thing with investment. More than 50% of the people, probably 90% of the people feel they are better than average investors. And that's not possible because average is the mean of all the people that are doing investments. Yeah. So overconfidence is another one of these issues. Fear of missing out. We are very socially driven people. And cocktail conversations or relatives, well-meaning relatives who share their success stories but not their failures, create the fear of missing out. And people get greedy when they shouldn't. And that leads to pain.
So true, so true. You talk, Sandeep, about peace of mind money. Tell me about this concept and how does one determine what is the right amount?
Peace of mind money, and in some circles, it's actually called with other choice verbs, but essentially is the money which if you had, you could do what you wanted and didn't give care in the world on earning money because you had enough savings. That's what I call peace of mind money. Now, how do you determine? There are a few things, 3 steps. First step is you need to know what are your expenses. And many people don't really have a good idea. So you need to create some kind of a budget. And in the book, we provide a template and a tool to get a quick estimate without, line by line budgeting exercise. The second thing you need to know is what would be my future big needs. So what is my retirement need? If I need to buy a house, if I need to educate my children or marry them off, whatever are my big needs, how much money would I need for that? Then the third step of it is you put it all together and you say, if I invest it in this or that way, will I be able to meet those needs for the time period that I have it? Now, when you put all of this together, then you have a good sense of do you have enough money today to be able to say, I don't care, I'm okay. And surprisingly, I have many, many very wealthy friends who, despite a tremendous amount of money, emotionally are not able to grasp if they have enough.
Right.
So it's not just about doing the math. It's also about understanding it at a basic level and knowing what money do you need so you can have peace of mind financially.
Well said. You also talk about the challenge of controlling emotions in investing. And a few minutes back, you did talk about how some relative comes and says, oh, I made so much money. We all tend to get greedy. How can investors manage their emotions when they're making or losing money?
Yeah, I think the key in managing emotions, I think, is twofold. One is there is tendency to check on something more frequently than is needed. A lot of people check their portfolios every day or sometimes even intraday. And that's not helpful. That is simply going to create a lot of anxiety on things that you can't control and are not beneficial for you to necessarily monitor on a live basis. So some of the emotional pressure we create for ourselves. We pay too much attention to things that don't work. And in the book, there is a whole section I call Avoid the Noise. So listening to, unfortunately, a lot of the stuff that comes on social media or even television sometimes is very reactionary. They're trying to ascribe reasons to things that are happening in the market that nobody knows. So they're trying to create theories. And avoiding paying a lot of attention to that is actually beneficial for your emotional health. The third thing we already talked about, having realistic expectations.
Correct.
So if you're making consistent gains, you're going to do fine. And if you know what you need to get to be able to peacefully live your, financial needs and requirements, then you'll do fine and be under less pressure.
Well
So
said.
know your goals, avoid the noise, and don't overstress it and overcheck it.
Well said. Well said. And how do you view the role of technology in democratizing investment advice? And I know from having known you for so many years that technology is really the backbone of what you are doing at Estee and Gulak. So tell me a little bit more about how can technology democratize investment?
I think this is actually a big mission for me personally. I think what is happening in our country is there is a shift happening from investments in real estate, land, gold, and the best financial product people used to use was a fixed deposit product. And now, over the last 3 or 4 years, crores of people, tens of millions of people have moved from these traditional investment vehicles, savings vehicles, to financial products. And I don't think many of them are prepared. Actually, SEBI has come out and said 90% of the people who are trading in derivative segments are losing money.
Wow.
So when you have the combination of millions of people trying to do financial investments, not achieving the results that are beneficial for them, then there needs to be a solution that needs to emerge. Now, the traditional financial advice industry, which is big, can only service people who have maybe 5 crores plus of savings. So the cost structure, because these professionals also need to make a living. So if they're going to provide you one-on-one attention, answer your questions, know your situation, they need to have enough of a corpus for it to make it worthwhile. So you have a problem. Most people who are coming into the market now have savings of, let's say, 10 lakh, 50 lakh, maybe even a crore, and they cannot be serviced by well-educated, individual, personalized professionals. So if you have that situation, the only way to solve it in near future is to build technologies which can provide that trustworthy knowledge base system that you can actually learn and get your questions answered. Because the problem is not just getting the information. There is plenty of information. You can Google and there is more information than you need. But then you have doubts, you have questions. And when the going gets tough, you need somebody to support you.
Right.
How do you do that with technology is the challenge. And actually, that's one of the things that we are working on passionately in my company.
Wonderful. The other confusion that a lot of people have, and when I speak to people, is that there are so many different types of products available. Mutual funds, stocks, fixed deposits, someone is talking of REITs, someone is talking of something else. Do you cover in your book what are some of the value propositions of each of these, and how does one determine what is right for me?
Yes, I think I do cover in quite some detail everything from stocks and bonds to real estate and real estate funds, even crypto and gold, and all the traditional ways of investing. I think the key is start with basics. If you want a basic plan, you really only need to know 2 things. Where you can't take risk, you need to have fixed income. Where you can take risk and want to make a little bit more money, you need to have a diversified equity portfolio. So really just 2 products.
Okay.
And then you can add on all the other complexity to make it better. Again, going back to eating, basics. You need protein, you need carbohydrates and a balanced diet.
Correct.
Of course, if you have vitamin supplements and superfoods, yeah, fine. But that's not what makes the bulk of your health and financial health.
Wonderful. A few minutes back, you spoke about us being able to assess what our needs are. How can an investor or how can an individual understand and prepare for their own liquidity needs, especially if you have a very significant financial goal?
So the liquidity needs are a important attribute of your financial plan. There are plenty of people, and in the book I cover some examples. The famous one was long-term capital management, which had several Nobel laureates as part of the company, and they were making amazing amount of returns till they got caught in a situation where they had a lot of assets but did not have liquidity, and they ended up going bankrupt. Liquidity means, can you convert your investment into ready cash? Now, you may own a big piece of land, but if you need to pay for a new car, you can't, say, take these 5 meters or 20 meters out of my land and give me a car. It doesn't work that way.
Yeah.
So you have to have liquidity needs understood and then plan accordingly. And that's very important if you're investing in things which go up and down. Because if you end up needing money when your investment is down, you will lose a big part of your investment potential gains. So I think understanding your liquidity profile is an important part of financial planning. And we talk about how to incorporate it into your plan in the book in some detail. But more your liquidity needs are short-term, more you need to be in things which will vary less, which will be more like fixed income, less like equity.
Right. Well said. Can you also talk a little bit about the difference between what you say is an absolute return and a rolling return? And why are rolling returns, why would rolling returns be a better metric?
So these are some of these things where technical knowledge helps.
Yeah.
A lot of people look at annual returns and sometimes they, give you the information you need. But it is possible in certain investments that January to December returns do not actually represent the full scope of what can happen, especially in terms of risk. So there have been many years where the stock market has been down 30, 40%, but by the year end, it was maybe up 3%. So if you are only looking at what happened year end to year end, you may say, oh, this product never goes down. But it is possible that from, June to May, it went down 30% because it was very high at some point and then went down subsequent 12 months. So rolling return gives you the ability to understand what can happen in all possible time periods that you're looking at, not just some specific cutoff points. That's why we encourage people to understand what is the maximum something can lose from its peak to its bottom. And that's an important aspect of investment evaluation.
That's it. So time for 3 more questions. You also talk about reverse mortgage in your book. Can you explain how this works and when it might be a good option? And why is this not used as an option by the elderly who may be asset rich but cash poor?
Yeah. I think the reason, well, first, let me just explain what is reverse mortgage. Mortgage means that you borrow from the bank to buy an asset. Now, at certain point, you pay it off, and let's say you have paid off your whole loan. Now, the reverse can be done. You can say, I'll pay back a loan, but you give me cash now. So you take that money and you use it for other living expenses. So that's a reverse mortgage concept. Why is it important? It's important, as you said, that some people, particularly elderly, have big assets. Let's say they're living in a big house, but they don't have other income to pay for their other needs, maybe medical needs or living needs. So they're sitting in a big multi-crore house, but they are really scrounging to make their day-to-day living expenses met. A reverse mortgage can help that. And that is particularly important if there are no other liquid sources or ongoing sources of income for you, because that house is not going to serve you when you are no more. Correct. It is going to go to your children or legacy or whatever it is. So either the children are supporting you in some sense, and that's fine, then you can pass the asset and they can give you that money. But sometimes people get into this bind where they emotionally are not able to separate these two things. So they want to pass the house, but they don't have the day-to-day resources. So we talk in the book on how to look at your overall portfolio, including fixed assets, to make those decisions properly.
Very well said. Two more questions. What do you hope readers will take away from your book, The Little Book of Big Gains?
I think to me, the simplest message is where we started. Investment is simple, but it is not easy emotionally. So you got to learn how to manage your process. That's the biggest message I'd want them to take. Then the second message is, if you follow some very basic things that we talk about in the book, asset allocation, knowing your profile, knowing your needs, then you will do better than average. And that should be good for an average person. If I can do better than average and I'm an average person, that's good. I think those are the two big messages that I'd want people to take away from the book here.
Well said.
And they can do it in about 174 pages in the book, of which only 80 have all of this message.
Yep. And my last question, and I've often said, Sandeep, once an author, always an author. What is next for you? Are you working on another book?
Ash, you have been a role model. You have written several books. I think you're on your 9th book now. I definitely aspire to follow on with another book. And the book I'm working on is a novel. Wow. It will be similar journey in terms of trying to understand how to live a happy life simply. So just like I've tried to put together how to have an investment plan simply, maybe I'll call it a little book of happy life.
Fantastic. And on that note, Sandeep, and my request to all our viewers and listeners to go and pre-order Sandeep Tyagi's book, The Little Book of Big Gains. I just want to say thank you so much for speaking to me. You know, you've explained, like you always do, complex financial terms in very easy to understand terms, which common people are able to relate with. And yet the message I take away is that it is a complex subject, so leave it to the experts. However, read your book, understand what is written in it so that you can ask good questions. Thank you again. All the very best for the book, which I believe is releasing in the middle of September. And good luck.
Thank you very much, Ash. And thank you for trusting. I know you are an investor with us as well with this. And thank you for this conversation. Very insightful questions. And I look forward to coming back when I write my next book.
Absolutely. Thank you. Thank you for listening to the Brand Called You videocast and podcast, a platform that brings you knowledge, experience, and wisdom of hundreds of successful individuals from around the world. Do visit our website www.tbcy.in to watch and listen to the stories of many more individuals. You can also follow us on YouTube, Facebook, Instagram, and Twitter. Just search for the Brand Called You.